Hi, Larry Gaines, PowerCycleTrading.com. Well, we're just starting to get in the midst of the early part of a new earnings season with the banks kicking off this week. And I'm going to show you a trade setup that we did on Wells Fargo. So this is an earnings trade using an option spread, what we call a double calendar. But the thing that's amazing about this is the flexibility that this trade setup gives. So first off, I'll show you the setup, and then the potential of this trade is the way it's structured is to potentially provide us a return of we risk $1 and make over 13. So that'd be like over 1,300% return on a very low at-risk cost. So first off, though, you can see Wells Fargo had its earnings today. They came out, they were good earnings, and this is a really tight volatility squeeze here on the daily. So you can see how compressed the price has been, and this has potential to break higher. So this is a daily chart. So our next target's like here to 4250 and then up to 4400. Here's what it looks like on the weekly. Still has good potential upside. So you can see the potential here. Here's the weekly long term. It's got even better potential up here to this 200-week moving average at 45. So we're targeting first target 42.5, then 43, 44, and then 45, 47, that area there. So the trade setup we did was a double calendar, and then we legged out to put us in a position to ride this for a bigger move to the upside. So let's take a look at the trade setup. So this is a double calendar. So yesterday on Tuesday before the close, the earnings were going to be this morning before the market opened. So what we did was we did a double calendar. We did a calendar 41.5. So bought the 23 April, sold the 16 April, 41.5 call calendar. And look at the cost, 17 cents or $17. That's the max risk. And then we did a put calendar together with it, buying a 38.5, 23 April, and then selling the 16 for a cost of 19. So the total risk on this trade going in is $36 per spread. So if you did one double calendar, your maximum risk is $36. So what we did today when this thing really exploded, we legged out of the trade and we ended up with a call debit spread where we have a total risk of $7 and a potential return of 93. So that's, that's like a 13-1 or greater return. So let me show you what it ended up looking like. So the real basis of this trade is this long 23 April 41.5 call. Okay, so that's the beauty of the calendar, is that we were short the 16 April 41.5 and then bought the 23, played the spiked implied volatility, which we play for earnings trades. And so what we ended up doing was we closed out the short strike, the 41.5 call short, took a loss on that, and then we had the 23 April 38.5 put long and short the 38.5 put the 16. So what we did there, closed out the long put on the 23 April, took a loss on that, and then left short or closed that out 38.5 put short, made a total profit of $27 there. So net our adjusted cost for this trade after taking in the losses from closing out the parts that we needed to get rid of was $70 on this 41.5 call. So here's what the end result was. So the end result was we adjusted the trade, the 23 April 41.5 long call that we originally had it on at 46. After taking the losses and adjusting it was $70 base cost there, and then turned around and sold when the market had run up today, sold the 23 April 42.5 call at $63. So now we've got a call debit spread, maximum risk $7, and next week if it closes over 42.5 at expiration we make 93. So that's a 13-1 or 1,300% return and on the risk of $7 and positive theta. You can see here the theta is positive. Now if we wanted to, we could even go one step further and we could convert this into a free trade by converting it to a butterfly. So what we would do there is we would just sell this vertical credit spread, the 23 April 42.5 43, went out currently at 26 bucks. Now you've adjusted this trade to a free trade. Now we have no risk. We actually would have a credit of $19. So if it closed to the downside, we would still make 19. If it ripped to the upside, we make 19. If it goes out at 42.5, you make over $114 on zero risk. So I hope you like this trade. If you'd like to learn more about these types of different option trades, join us at PowerCycleTrading.com. Good luck trading.